Hey everyone, it's me, Corrie Sommers, your local Los Angeles realtor. Today we're going to be talking with a lender who is sitting right next to me about loan programs that are available for people who are self-employed or 1099. And this is an important topic because sometimes I have clients that think they can't buy a home because they're self-employed or 1099. So stay tuned, we'll be right back. Hi everyone, it's me, Corrie Sommers, your local Los Angeles luxury realtor. Today I'm here with Dallas Rutherford of Cornerstone Mortgage. We are embarking on a second segment of our, couple little video series here discussing different aspects of financing with purchasing a home. So today we're going to be talking about the options that are available for people who are self-employed or 1099. And the reason I wanted to have this conversation and bring this up, this is a conversation I have with a lot of my clients who are owning their own businesses, very entrepreneurial, or have multiple businesses and aren't really sure how to finagle through in order to get a loan, because while they might have strong down payments of 15%, 20%, or even 30%, they still need some sort of financing. So first question is, if someone is self-employed, what are some of the loan options available to them today for financing?
Great question. So we have a ton of non-QM products. I would say that's actually one of our specialties, and I'll get into the reasons why. But a lot of direct lenders, which I'm like a mix of a direct lender and a broker. So I have in-house options and I have out-of-house options. So a lot of the times people that are offering these bank statement loans, they're getting the file, they're packaging it up, and they're shipping it to a different investor. And so when that happens, typically the broker or the lender charges a broker fee to broker it out to the company, and then if that company has any fees, which a majority of 1099, no income, bank statement, self-employed borrowers, those types of loans that they're using, they get charged points. There's typically always points with these non-traditional, non-QM type of loans. So the difference between us and a lot of other companies is we actually have in-house non-QM products. And again, non-QM products are for self-employed borrowers, people that are 1099, people that run businesses that are super aggressive with their tax write-offs, so they can probably afford a home, but when it comes down to qualifying conventionally, they're not able to qualify conventionally due to the amount of write-offs that they have on their tax returns. Yeah. So just to kind of go through a few of them, we have bank statement programs. All we do for bank statement programs is literally just your bank statements. We don't look at your tax returns, we don't look at your W-2s, we don't look at your pay stubs. We have a 3-month bank statement program, we have a 12-month bank statement program, we have a 24-month bank statement program. Typically the credit score requirement is a 640, and you're gonna have to have a larger down payment. So for a self-employed borrower that's aggressive on their tax returns, let's say a guy makes $300,000, and in order to show that, he's got to pay $90,000, $80,000 in taxes to Uncle Sam, which he'll never ever see again. He's got to pay the IRS. He's doing that to qualify conventionally to show that income. And again, just like in the other video, I said people with money are smart. So someone that's smart with their money would rather pay a higher down payment, because with bank statement loans, you have to have at least 10% down, 10 to 15 to 20%, depending on the loan amount. But in their eyes, they'd rather pay into the equity of their own home rather than paying Uncle Sam and never seeing that money again. Or they'd rather pay the 10% and also make their money work for them. So a bank statement program, typically the interest rate's anywhere from high 5s to low 6s. And right now, conventional loans are at high 4s, low 5s. So there's really not like a huge gap.
So
right
maybe
now,
just like 1%.
It's usually about a 1% difference, again, depending on credit. But that's if you break that down into a monthly payment, it's not that big of a difference, 1%. It really isn't. So in their eyes, sure, I'll pay an extra $1,000 a month on my mortgage because I'm going to use this 70 grand that I didn't pay the IRS to use it for my down payment. And also, I know that I can put my money in a vehicle that makes 8% a year, or 10% a year, or 12% a year. So they're just really, really smart with their money. Yeah. So bank statement programs, we have 1099 loans to where all you have to show is your 1099 stubs. We have DSCR loans. A DSCR loan is where you don't have to show any income. You use 20% down. and we use the income based on the rental survey that we get back from the property. So as long as the rental survey comes back in the appraisal and that number covers the PITI on the property, we will lend on the property.
I want to rewind just a little bit because you threw that
last
one out there, and it's kind of a different ballpark. So a DSTI is for a property that...
DSCR, debt service coverage ratio. That's what it stands for.
Yeah,
DSCR.
So if you're purchasing a duplex or a triplex or a home with an ADU, would that work? Or
Yep.
any kind of rental property on the property?
Yeah. So the DSCR loans are typically, I'm 99% sure that the DSCR loan programs are for investment properties only.
Oh, not that you're living on and having
exactly.
rental income. Okay.
But we do have no income loans, which is basically the same thing. Instead of you qualifying based on rental surveys, all the bank for a no income loan, which again, it's literally called a no income loan. You don't have to show any income. All you need to have is 20% down, and they're going to ask to see reserves. So typically you only have to show one bank statement. So if you have one bank statement, say you're buying $1 million property, in that bank statement you need to be able to show $200,000 for your down payment, a little bit more just for closing costs, and then based on your credit score you have to show reserves, and the reserves are just your monthly PITI.
Right.
So the higher the credit score you have, if you have a 740 plus, you only need to show 3 months of reserves. If you have a 700, then obviously it goes down that funnel. Instead of 3 months of reserves, you're going to show 5 months. And the lower your credit score goes, the more reserves that you have to show. So you can use that for an owner-occupied property as well, which again, you're not even really leaving it up to the appraisal survey that comes back. But both of those options are fantastic for self-employed borrowers, or even anybody. We have W-2 people that do that as well too. You know what I mean?
So there's an advantage there, even if you could do a standard loan.
Yep. So again, and what I was getting at is we actually have these loan programs in-house, and so that's a big advantage, because that means that the underwriter that I personally know is underwriting the file. I have better communication. So if we're in escrow and I'm brokered the loan out, which we can do that too, but if I broker the loan, someone else's company is underwriting it, there's other people involved in the transaction, I really can't get an answer to my clients as quickly as if I had this type of program in-house, where I can call the underwriter, I can see who's working on the file. So it makes communication better with your client and just the overall process a lot easier.
Okay, so that's really great. So there's definitely options, and that's one of the things I always try to get my clients to understand, because sometimes I start working with people before they get their pre-approval and they say, well, I want to buy, but I need to save more money, or I don't think my credit is there, or, oh, I need to get a regular job because I work for myself. And so knowing how mortgages work, I think works in my favor, because I'm able to kind of talk them through some of this. But as we've shared, part of the reason we're doing this together is because I don't do what you do every day, and things change and programs change. And just like the last one you explained, that was not available when I worked in the mortgage industry. So there's always changes. So it's really important when you're looking at buying a home, don't be discouraged. I always say there's almost always a way. It's just really talking with your real estate professional and their relationships and exploring those options and finding the one that works for you, because there's something out there that will work for you. And the way interest rates are rising and the way inflation is happening, you don't want to sit on the fence and wait it out another year or two. You will not be able to purchase as much then as you can today. And that can make all the difference between a home and a condo. It can make all the difference between the size that you really need and a small home. Sacrifice, location, it makes a difference. So I just want to encourage everybody watching today, if you're thinking about buying and you were just concerned and that's what prompted you to watch this video today, there are options for you. Dallas's information is below, my information is below. Contact either one of us and we can help you out. Thank you guys so much for watching. I hope this has been helpful. More videos to come always. So if you haven't subscribed to my YouTube channel, please click the subscribe button below and the bell for updates, and more will be coming soon.